Hi, everybody. Laura, are we going to begin?
Yep, let's go.
All right. Hey, oh, 0 to 1 billion. Uh, Everyone, welcome to Peerscale Power Session. I'm Joel Lessam. As everyone probably knows me, Executive Director here and longtime CEO member. I have the pleasure. Well, before we start, I just want to mention you probably saw we have some events coming up. We have our AGM and quarterly event on April 24th, and we have the retreat. So be sure to early June to register for the retreat. Um, and we have a very exciting presentation today from Michael Ho, who was a member. We were in the same roundtable together, I think, along with Dave Millier, who's on the call here, and I'm sure some other, and he knows Mark Moran. Um, and Michael was CEO of Bearing Media, which was a venture-funded uh, technology company, which he later sold. And then he went on and joined the dark side. And I'm kidding about that, but he went on to the venture side of the equation. And now he's returned to counsel uh, entrepreneurs, CEOs who are considering venture capital or going down that path, and lessons learned, and what you should really be thinking about as far as um, uh, spending capital and allocating capital efficiently. So with no further ado, I'd like to welcome Michael to the Peerscale Para session.
Cool. Thanks. Thanks, Joel. Matt, Paul, appreciate you having your cameras on. Everybody else, if you feel free, I'd love talking to faces. And it's nice to see some familiar names throughout all this. Oh, there we go. See? All we have to do is one little ask. There we go. Hey guys. All right, let's get started here. We got a small group, so I try to monitor the chat, but you can also do your like little raise hand thing, and happy to take questions throughout, but we should have time at the end as well. All right, we're going to talk a lot today about seed to Series A. And not so much because round names actually mean something. There's a lot of data out there that shows now that round names are kind of silly. They were made up by investors so that we knew what to name an actual term sheet. And we're going to talk a lot more about the milestones behind it. But I'm going to kind of give you context on how I think of round names, particularly Series A. And the reason why is that Series A is just such an important role in a journey of a startup. And you're going to see it happen over and over again throughout the journey of that same startup. So for me, Series A typically means you're ready to scale. Most products go through basically an S curve. And you can think of Series A as at the beginning of the kick up of that S curve where it's going to go exponential. So Series A is usually synonymous with you're ready to scale. Why is that? Because if you're looking to go down the venture path, a Series A typically, the median Series A, I think is around 9.7 million or 10.3. It moves around a little bit, but it's typically around a $10 million raise. The narrative you're trying to say around a Series A is that I'm going to raise $10 million so that I can add $10 million in net new revenue. Typically, net new logo revenue is preferred in 24 months. Okay. That's kind of the definition of venture scale, which is why we need to be ready to scale to be able to consume that capital and not burn that equity on our side. Series A is also in and around product market fit. And so, like I said, it's not really about the round name, but it's more about the milestones and the business milestones we're going through. And in and around product market fit is around when Series A happens. Here is a quote that I really like. If you're familiar with Zig Ziglar, sort of one of the OGs of productivity, you can't hit a target you cannot see, and you cannot see a target that you do not have. My challenge was that no one really told me how to define product market fit. We talked about it. We said we needed it. We definitely said you can feel it when you don't have it, and you can feel it when you have it. But no one ever described what that actually looked like. My hypothesis on all of this and where I kind of pulled the thread after being a VC was, what if you could define it? If you could define what product market fit looked like before you actually got there, that would give you a roadmap to Series A. It would let you know when you're actually ready to scale so that you can manage your runway accordingly. Most people raise money for 18 to 24 months and just spend for 18 to 24 months, but they don't modulate how they spend their runway against, are they making progress against product market fit? The other thing that I've found is that when you can properly define product market fit, your internal conversations become a lot easier because you can focus your team around what really matters. Are we de-risking the right parts of our business? So that's our goals here today. Oops. The other thing I've learned is that product market fit's not at a company level. Product market fits at a product and a market level. Every time you change your product, every time you change your market, that's a new version of product market fit. So this concept of product market fit or Series A becomes this building block that you see throughout your company as you grow. Every time you launch a new product, we've got to go refigure out if we have product market fit. From seed to Series A is our first version of product market fit. Eventually, we need to do another version of it, though, and that'll take us through Series B, C, and the rest of the alphabet rounds if we're going down the venture path. So it becomes this repeatable building block that we're going to talk about today. All right, a little bit of background on myself. This is actually my picture, that suit picture that was on that little carousel there. I have no idea where that one came from, but this is my picture here. Black t-shirt, black hoodie, that's me. I started my career at Nortel Networks. This phone was literally on my desk, so it was that long ago. This was pre-dot-com era when they were buying Bay Networks. I was a software engineer there. I was writing code for their Japanese line card. So I cut my teeth at sort of the engineering side of things. Then I moved over to Mark Morin's company here and moved into sales as a sales engineer. I started pre-revenue. I just lucked into that role. It was perfect timing. We were pre-revenue, got to play or see that journey as we went to basically $100 million in revenue and went public on the Toronto Stock Exchange. And this was around 2007, 2008 when I left. What was nice about this was my first experience at sales, but more importantly, where I got to cut my teeth at the concept of enterprise sales. And if you look at raising venture capital is really just an enterprise sales process. So if you're good at enterprise sales, you understand sort of at least the mechanics behind how to fundraise. Around the Great Recession is when I started my company. So obviously perfect timing to start a company. I started Bearing Media with some co-founders. We grew that company from 2007 to 2014, which is when we exited that company. I became the CTO and head of product at our acquiring company. And 3 years later, we sold that to the fourth largest cable company in the US, which was Altice USA at the time. After a year off, I kind of wanted to go see what it was like to be on the other side of the table. I wanted to understand the psychology that was going through VCs, how they were diligencing companies, and just understand really what that process looked like. So I became an investor for Mars IAF for about 5 years. They were my first institutional investors. Realized I did not like deploying capital, but I loved working with companies. And so that's what I do now. So throughout my journey, one of the things that I wanted to understand was how do venture capitalists look at businesses? And one of those things is being able to define their version of venture scale. And if you're ever going to go down the path of venture capital, I think it's really important that we understand how, like, simply how do they define venture scale? Because then we know whether we're on that curve or not. This just allows us to know the game that we're playing. So here's the simple definition of venture scale. Once you start at $1 million, so once you cross $1 million in revenue, the goal is that you can get to 100 million in revenue in basically 7 to 10 years. If you follow it in 7 years, this is a common triple, triple, double, double, double path, which means after $1 million in revenue, so however long it takes you to get that $1 million in revenue, after that, you triple the first year, you triple the year after that, then you double, double, double all the way to $100 million in revenue. The part that you should focus on, especially for sort of that Series A timeframe, is this part, the first couple of years. The first triple triple means that you are growing at 10% month over month, compounded for 24 months straight. Okay. This is massive growth. This isn't just growth. This is growth. This is venture scale growth. And the mechanics to be able to do that is what we're going to talk about here today. So once we understand what we're trying to go for, we can start working our way backwards to how do we actually accomplish that. Unfortunately, the last couple of years have kind of took a skew on this and said, well, growth at all costs is the way to grow. Sequoia's gone on record now. Most VCs are talking about this. This is sort of the thing du jour, but growth of at all costs is over, basically. So it's not about raising a bunch of venture capital and faking it with just by spending a lot of money to power up that growth. We want true product market fit. So the name of the game now is capital efficient growth. And we're going to talk about what this actually means. But what it doesn't mean is this doesn't mean profitable and low growth. So if you're going to go down the venture capital path, we need to understand that we still need to hit venture scale growth. We just need to do it in a capital efficient way. And that's what we're going to talk about today. We're going to talk about the missing venture scale slide. So if I looked at your pitch deck, we want to make sure that you have this venture scale slide that talks about how you plan to do capital efficient growth. How are you going to go from that $1 million to $10 million in 24 months? We're going to use Uber's story because it's easy to think about on how they went from 0 to $10 billion in 10 years because it's easy to visualize. Now, they're not the poster child for capital efficient growth, obviously. There's one part of capital efficiency that they did very poorly, and then there's one part that they did really, really well. And it's the part that they did really well that we're going to focus on. Now, obviously, you're not Uber. You're probably not using city hopping as a strategy. So we're going to talk about how to make it work for you. And then we're going to talk about what are the signals that you need to look for so that you know that you're on track to this concept of capital efficient growth, venture scale, product market fit, and Series A, because they're all interrelated. One thing also to note is that you've probably been lied to as we've gone through or as the ecosystem has talked about raising capital. Most people focus on you need traction in order to raise capital, which is actually true for 98% of companies. So this is a good thing to talk about. But I think where people get mistaken on this is that traction doesn't automatically equal funding. So you've probably been told at some point that $1 million in ARR equals a Series A. Now we're saying, no, it's not $1 million in ARR. It's $3 million in ARR equals a Series A, or some version of this. Now, we usually think about traction. We think about users, revenue, and growing at 2 to 3x year over year. But does traction actually equal funding? So my company at $5 million, we had thousands of users, we had 5 million in revenue, and we were growing at 2x year over year, but we struggled to raise our next round of financing, and it was one of the reasons why we got acquired in 2014. Uber, on the other hand, at $5 million, had thousands of users, 5 million in revenue, lots of growth, and easily raised more money. And why is that? So traction doesn't automatically equal funding. It's the leading indicators to that traction, the quality of that traction, how that traction came to be that VCs will be diligencing on you. And it's about understanding and making sure that you've got the right leading indicators. Especially in today's days and age, you can get to quite a lot of revenue on founder-led sales, right? You can have huge enterprise accounts. This doesn't mean that you're set up for venture scale growth or ready to scale. So high-level traction metrics like revenue, users, or just high-level growth metrics doesn't necessarily mean that you're ready to scale. You need to double click into that and look at the leading indicators. It was this concept that led me to sort of the framework that I'm going to walk you through today. When I was on my year off, I studied productivity, the Zig Ziglars of the world, and came across this quote. Oh, just lost my screen here. Came across this quote that basically said the secret to success is quite simple. It's to do less, do it more often, and keep getting better at it. And it kind of hit me like a ton of bricks because I thought back to my career on any time I struggled, and it was typically because I did the exact opposite of this. I would try to do more, which meant I did it less often, which means I wasn't getting better at it, and I'd start spinning my tires. So the framework we're going to work through today is that the secret to success in your startup is quite simple. First, we need to find something that works. Once we have that thing that works, we need to shift into execution mode and do that thing that already works more often. And once we have that, then we can keep finding more things that work. Relatively simple. It also nicely matches up with our fundraising periods. So seed stage is all about finding something that works. Series A is about taking that thing that works and scaling it and doing it more often. That's how we go from $1 million to $10 million in 24 months. And then Series B is then about finding more things that work. That'll take you through Series B, C, D, which is just a repetition of seed to Series A throughout all of these processes. We're going to cover how Uber did this. Then we're going to look at an enterprise sales play, a B2B SaaS, a consumer play, a marketplace, and then my favorite, a moonshot or a deep tech company, how they all follow this exact same path on how they scaled up, and so that you can see that it'll also work for you. So let's start with the missing go-to-market slide in basically every pitch deck that I've ever seen. Here's how most people communicate their go-to-market strategies. How we make money, and here's how we're going to grow. So if we look at how we make money, which is super important, you can think about how you make money in two ways. First, here's our pricing model. So we use this thing called surge pricing, minimum fare, minimum dollars per kilometer, and then the tactics on how you're going to make money. We're going to use network effects, BDRs, SDRs, a sales process, paid media, whatever your actual tactics to grow with. This is really important for people to understand and set context. However, we usually jump to this. And here's how I'm going to scale. First, I'm going to do this thing called Uber X or Uber Black. Then I'm going to do something called Uber X, then Uber Pool, and then Uber Eats. What happens though is as a VC, all I hear is that I'm going to do something and then I'm going to scale by doing something different and then different and then different again. And what does different mean? Different means slow, untested, and expensive. And that's not what we want if we're going to go into venture scale. Whenever we put this slide in the deck, it's the slide that you'll spend the most time talking with. The VCs will go, this is the most important slide in your deck as it relates to diligence, because this is how you're going to hit and stay on the venture scale path with your first product, which at Series A is probably the only thing that's important. So you're going to see this play out with Uber in 2011 when they raised their Series A, and then we're going to get into the mechanics of it. So Uber, like every company, started with a multi-billion-dollar market, a big, giant vision. This is from their pre-seed deck, which was a $4.2 billion annually and growing market. So I'm guessing that you probably have a giant vision that's in the multi-billion dollars. And like Uber, you started with or you have limited resources. Every company's under a limited resource constraint. No startup, doesn't matter if you're seed, Series A, Series B, or even Series C, you probably don't have enough resources to tackle a multi-billion dollar market, right? All at once. You'll die of indigestion if you try to solve all the problems at the same time, and you'll just be spreading yourself too thin. So let's look at the journey of Uber. They were founded in 2009, and they raised a paltry $200,000 from the founder, and they started with a tiny, tiny sliver of their $4.2 billion market. Uber Black in San Francisco. If I were to wager a bet, I'd say that's probably less than $100 million addressable market. Uber Black in San Francisco. Expensive, high income, just San Francisco, tech workers only. It's a tiny, tiny fraction of their initial market. 2010, it was all about finding something that works. They raised a $1.3 million seed, and they got Uber Black in San Francisco to $1 million net to them blueprint. Now, this is where they did capital efficiency poorly. They basically used venture capital dollars to subsidize their pricing so that they could beat out the limos, the taxis and all of that kind of stuff. So this is the part where they were kind of capital inefficient in terms of using venture dollars to subsidize value to the end subscribers. But regardless, we're going to skip over that step right now. $1.3 million, $1 million in revenue net to the company. So this is basically $1 million blueprint. Now, this is where things get interesting, okay? So they raise it's 2011, they raise an $11 million Series A. It's a normal Series A, especially by today's standards. They had this $1 million blueprint. Now, what did they do next? Most companies, most startups would say, great, I've got Uber Black in San Francisco. I'm already headquartered in San Francisco. I should build Uber X because Uber Black's, what, 5% of the population? If I build Uber X, that would be 95% of the population. I should be able to scale really fast. But that's slow. They have a bunch of untested things that they would have to do. So what did they do? They just took what already worked and they did it more often. They had Uber Black in San Francisco, which was a blueprint that they had figured out, and it produced $1 million. They went copy, paste, 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 paste. New York, Seattle, Chicago, every other major city. They went from $1 million to $5 million in less than 12 months. They shifted from experimentation mode into execution mode. This is the key part that a lot of startups miss, is that at some point you have to shift out of experimentation mode and you have to shift into execution mode if you're going to kick up your venture scale curve. What that allowed them to do is raise their Series B in less than 12 months. Now they've raised, at the end of 2011, they raised a $37 million Series B round. Now they have a lot of resources. Now they can use money to double down on Uber Black, but they can take 20% of that money and kick off a new seed stage startup inside their company. And this is what we call our expansion strategy. Now we just find more things that work. And they're going to follow this on. So they go from $5 million to $15 million. Most of that's coming from Uber Black, but they're relaunching this same process with Uber X. Make it work one place, then shift it into execution mode. By 2013, they've raised their $363 million Series C. They went from $15 million to $105 million. This is all net to the company. Uber Black and Uber X is driving most of that revenue now. Then they went from 105 to 500 million doing Uber Pool. And then they went from 500 million to $1.5 billion by launching Uber Eats. They just kept repeating this process over and over and over again. First find something that works, then do it more often, then keep finding more things that work. They rode those four horses from 2016 to 2018, $3 billion, $7 billion, $10 billion, and that's when they went public in their market. And that was $0 to $10 billion in a 10-year period by continually experimenting. Then once it works, 100xing down on execution mode after that. And it's that shift into execution mode that we want to focus on. So it all starts here. First, you've got to find something that works, and we need to define what works means. But once you have it, you need to move that into execution mode and go from $1 million to $10 million in ideally 24 months if you're going down the venture scale path. So if you're going to raise capital, you want to be able to show the investors the right go-to-market strategy, which is here's how we're going to find something that works. Here's what it's going to look like when we're going to do it more often. And then here are the things that we're going to keep finding more things that work. And when you're at your seed stage, Series A or Series B beyond, you're just at a different path along this go-to-market strategy. And you're just starting to fill it in with the right signals, the right stories to back it up. And that's kind of the stuff we're going to focus on next. All right, let's talk about how to make it work for you. I like Uber because it's really easy to visualize. You can see San Francisco, you can see New York, you can see Seattle, so on and so forth. This is the part of the presentation where most people goes, this is great, but that's great for Uber, but that's basically 1% of companies that are out there, right? We're not using a city hopping strategy. This will never work for me. So here's my answer to you that cities are not the only way. It's just a place to see that we can see the framework actually in action. So let me show Sandvine and show Sandvine how we scaled from 0 to $100 million. We had a single product, session management. We initially focused on, or we scaled by using not where the customer was, but who the customers were. So we had a product called session management with cable companies, and we initially started with what I'll call single box deployments, single data center, low enough bandwidth that we could jam all that bandwidth through a single box. That process allowed us to make sure that our product delivered value, allowed us to figure out our sales message, allowed us to figure out our sales motion, allowed us to build up all of our sales materials, our decks, and all of that. We were able to make $1 million from that across a couple of accounts. We were able to figure out something that actually works. What did we do from there? We scaled it. I spent my entire career at Sandvine just basically doing the same thing over and over and over again. I was initially flying around for single box deployments. Then we went to multiple box deployments. So this is the same data center, bigger rack, more bandwidth. Now we need to put multiple boxes through. Our product didn't really change. We changed our deployment model. Our sales message stayed the same. Our sales deck stayed the same. It was still the same sales motion that we were using, but we made another couple $1 million. Then we went to multiple sites. Multiple sites was just multiple data centers, a new set of deployment challenges. But again, the value proposition, what we did as a company didn't change. Then we ultimately went to Time Warner, and then we went to Comcast. All of this was the same execution mode. And every time we shifted to the right, there was a little bit of change. But we didn't fundamentally rebuild the whole company every time we shifted to the right. The box got bigger. We had variations on the box, but the core value proposition of it stayed the same as we scaled through this. So all we did is we focused on who the customers were rather than where they were. HubSpot did the same thing. HubSpot started as an CRM, all-in-one CRM for small, medium-sized businesses. They made all of their first money on that one product, right? And they invented inbound marketing, and they just changed the front door that people came through for their inbound marketing. If you go back on the Wayback Time Machine around, I think it's like 2000, can't remember what it is, like 2007, you can actually watch their blog strategy unfold. So first, all their blog articles clustered around SMB strategy. Then it clustered around internet marketing. Then it clustered around SEO, blogging, and then advertising. Each one of those drove a bunch of traffic to them, but they didn't have to change their product. They didn't have to change their marketing messages, their value proposition, their pricing plans, all of that stuff, the mechanics behind what they were figuring out in the first SMB strategy version worked as they shifted into execution mode and just changed their ICP a little bit, a tiny bit each and every time. Facebook was another famous one that focused on where the customers were. HubSpot focused on what problems the customers were solving. So Facebook focused on where the customers were. So not just geography based, but the schools that they attended. So famously, it was Ivy League schools, then other colleges, then high schools, corporates, and then everybody over 13. But if you go back in time and you look at the Ivy League schools, they focused not just on any Ivy League schools. First, they started with Harvard because that's where they were. But from there, the next schools they picked, they had a lot of thought process into why are they picking this next school? And it turns out what they were looking for was schools that likely had overlaps with friends at Harvard. Why is that? Because when you would jump on early on when they were launching that school, they'd want you to see some of your older friends there already on the network. Go to market is all about slicing up your bigger market and then prioritizing the order that gives you the most capital efficient growth plan. where you can get leverage as you are going and scaling this over. So that's really the narrative that we're trying to figure out, because that's where we don't have to build millions of things. We can go find the path that we naturally win in. Airbnb is another one that used where they were, but instead of geography, they use status quo and the channels that you're currently going through. So they used their initial one was actually going after and scraping everybody who is listing their Airbnb, or sorry, their room on Craigslist. So they used where the customers currently are located and what's the status quo or channel that they're currently on. So this is just another way to sort of think about how to take your market and break it up and sequence it. And then my favorite is SpaceX. SpaceX did with their Falcon rocket. You can go back and look at all their launches, and they focused on why the customer wanted to launch a rocket. First, it was low Earth orbit, then geosynchronous transfer orbit, sun synchronous orbit. I don't know what any of these means, but you can actually watch their launch schedules play out, and you can see what their strategy is. I'm sure there's a reason why low Earth orbit has 45 launches, while geosynchronous transfer orbit has only 35, and it starts to waterfall down after that. It could be that it's easier to win those customers. It could be that there's just more of those customers, the value's higher for those customers, or it could be that their tech actually just works better in low Earth orbit versus sun synchronous orbit, and they had to change some stuff as they kind of moved over to the right. But how you sequence this is what gives you your capital efficient growth plan. So it works for an enterprise play, a SaaS play, a consumer, a marketplace, and a moonshot. It's about figuring out the right story to tell investors, right? We need to understand what that thing that works is, and then we need to understand how we're going to sequence out our go-to-market strategy. Are we going to use who the customers are, what problems they have, where they are, or why are they trying to solve this problem? And that's how we're going to scale, by just taking what already works and doing it more often. From there, we can then go figure out something new that works and repeat this process over and over and over again. But we need to be able to narrate this story to investors. So now we know sort of what the high level framework is. We need to know what the story, we know what the story is. Now we need to understand, where are we in that journey? It's easy to say something, it's harder to show it. And so we need to talk about, how do we prove that we're actually ready? So what we're going to do is, now we're going to talk about, how do we define what works means, or more specifically, how do we define what product market fit means? Here's a simple definition. Two parts to product market fit. First, you need happy customers. That's commonly called problem solution fit. Some people call this product market fit. I don't really care which one you use, but in order to scale, you need happy customers, and then you need a factory to create more happy customers. We don't need to make it any more complicated than that. The factory to create more happy customers is typically called go-to-market fit. So product market fit, in my definition, has first problem solution fit, a few happy customers. We know that we're doing value, giving value, and then we need a go-to-market motion that works, and we can call that go-to-market fit. Now, as I was going down this path, I came across this quote from Elon Musk when he was struggling with the Model 3 and ramping up production. And he basically said that building a factory is 100 times as hard as building a car. Yeah, Matt.
Yeah, sorry. My question was, and I think the examples that you're giving are really like, the companies are quite unique in terms of what they're doing. Like, when you think of product market fit and you're looking at companies, how much does competition factor in? Like, I could sort of see, you could create a happy customer, but if your competitors are also creating happy customers in a better way, like, that's obviously a problem.
So let me get to
Yeah.
that right after we talk about sort of the mechanics behind, like, the definition, but that's a good question. So if we know product market fit means we need happy customers, which is your car, and then you need a factory to produce happy customers, which is your factory. According to Elon Musk, when you're building an actual car and trying to ramp it up into production, building the factory is 100 times as hard as building a car. Here's my experience in product market fit. building your car, building happy customers, and Matt, this is a bit to answer your question, but building your car and a few happy customers, that's hard. You got to build the product, you got to give value, all that kind of stuff. Building a factory that can repeatedly and scalably produce more happy customers is 100 times as hard as building the car because of competition, macroeconomics, just figuring out go-to-market motions. All of this now starts happening, which is why when people define happy customers as product market fit, I cringe a little bit because that definitely means you are not ready to scale because you have so much that you still have to build throughout this process. One of the problems, though, especially in VC land, is that you get a bunch of happy customers, you raise a bunch of money, whether that's your seed or your Series A. And if you don't have this factory figured out, you start spending money as if you have product market fit because you're being told by everybody that you should spend money and scale. And what happens, you just start incinerating your equity, right? Because this is, if you don't have the go-to-market motion figured out, you can't throw capital at this problem to solve it. So here's what most startups do. Most startups build the product, and the product is hard to do. And worse, they have a huge vision, and they get customers across their entire market. So what did that tell them? Look, my product works for everybody. This is amazing. My product does what I was expecting it to do, and it works for everybody because it should, because we're trying to shift out of experimentation mode into execution mode. But what happens is they say, okay, good, I've got customers, happy customers everywhere, which means I should be able to build every single one of my factories at exactly the same time. Once your product works, your limiting factor, your constraint is your factory building resources, your execution resources, your operational resources, your go-to-market resources. These are your limiting factors. What most startups do is they start spreading themselves thin. They start trying to build all their factories at the same time. The most scalable startups start pressurizing their limitation. They use their constraint to their advantage, and they prioritize their resources accordingly. They build their factory in San Francisco, then they build their factory in New York, and then they kind of sequentially do that. They usually have maybe 2 or 3 that are in progress, but they're not equally in progress. We want clustering. So we want to win. So Matt, to answer your second question against competition is, your goal is not to figure out who your competitors are in $1 billion market. Your goal is to figure out an ICP where you beat your competitors and focus all your resources there. Win that first. Then find the next ICP that's right to the adjacently to the right that can leverage your advantage starting out and figure out that one. Go-to-market is all about prioritizing your market, not about just how and what tactics you're going to use in a big giant market. So if we now know that we need to figure out a factory, and this is the key because this is the part that's 100 times more difficult than actually building a product, and it's the part we underestimate the most. We have to define what a factory actually looks like. There's 4 parts to keep it super simple. First, you got to find customers. Then you got to win customers. Then you have to deliver value to those customers. And then you have to retain those customers. And you have to do all 4 of those things in a repeatable and scalable way if you want a factory that can produce more happy customers. Okay? So let's define repeatable. Repeatable means in my simple definition of repeatable, you've done something more than 10 times. I keep the comments really, really simple, so we don't need crazy analytics to figure out, do we have or do we not have product market fit? Here's the key, though, is that we got to define repeatable across every single part of this. Have you found more than 10 customers? Have you won them? Have you delivered value? Have you retained them? All the resources that sit behind how you find customers, win them, deliver value, and retain them. Do you have 10 resources that you've ramped up and trained to do all of those? If anything is less than 10 in your factory blueprint, you have a risk point. It doesn't necessarily mean you can't scale, but you do have a risk point. This is one of the reasons why 3 million ARR on founder-led sales is not scalable. I've seen it time and time again. You get to $3, maybe even $5 million in founder-led sales. You raise $10 million. Do you think you can just hire a sales team and replace the founder with a sales team? 9 months later, what usually happens is we fire the sales team. We've lost 9 months. We've burnt through probably $8 million because we didn't just hire salespeople. We hired engineers, we hired customer success, we hired support, we hired product people. We burnt through usually $7 to $8 million and 9 months of runway like that because we didn't know that we were ready to scale. So this is your simple rubric on, am I ready to actually scale? Have I proven every part of my blueprint? 1, 3, 10, right? The closer you are to 10, the more repeatable it actually is. So let's look at this actually play out in Uber. So Uber used cities to scale. When did they hit product market fit? Okay. Most people think they hit product market fit in San Francisco. Sure, they had more than 10 drivers, they had more than 10 users, they had more than 10 users who took more than 10 rides. All of that was true relatively fast in San Francisco. Took them about a year from San Francisco to launch New York. From New York, it took about 4 or 5 months to launch Seattle. Then they started picking up the pace. The last part of their version of product market fit was their city launch playbook. Now look at what happens when they launch 10 cities. So I drew the line there when they launched 10 cities. Once they launched 10 cities, they went completely exponential. Why is that the case? The difference between San Francisco and New York was probably 40%. There's probably a lot of changes that didn't translate. What worked in San Francisco won't necessarily work in New York. But as they kept iterating on this playbook, they started ironing out all the differences, and all of a sudden, they actually had something that works. The difference between launching San Diego and Atlanta here was probably pretty low. Same thing with Denver, Dallas, and all that. They had the mechanics of their playbook worked out. They had the hiring, the onboarding. They had city launch teams. They knew the playbooks that they were running. If the city did something they didn't like, they had a way to do a back-off algorithm. They had playbooks to handle things that would go wrong. This is true in anything that you're learning. Usually somewhere around the 10th time you did it, you understand the problem space and you understand how to put it into motion, right? This simple concept of go through every single thing in your blueprint on how you're going to build a factory to produce happy customers and just score it. Have I done it once, 3 times, 10 times? That will just give you a simple roadmap to follow on. I need all of my numbers close to 10. Any company that's at scale has done all of this more than 10 times. So we know the framework. We got to find something that works. We have to do that thing more often. Then we keep finding more things that work. We know the story that we need to tell. When we say our thing that works, we need to pressurize that down into an ICP so that our competitors aren't really there, that we're beating our competitors. We need both the happy customers and the factory to produce happy customers in that one thing that works. Then we need to start ramping it, right? We need to test to make sure that we can prove that we have the right signals to show that it works. So we have all the right happy customer signals, and we have all the factory signals that prove that we are ready to scale it. Once we do that, we can actually start moving on to do it more often. Now we find our next ICP, and we just repeat the process. We got to go through 1, 3, and 10 for every part of it. Then we go into our next ICP and our next ICP and our next ICP. Eventually, we have to launch UberX, and then we have to launch Uber Pool, and then we have to launch Uber Eats. And each new product, we just keep going through this exact same process. Start at 1, then get to 3, then get to 10. The one nice thing is usually launching your second product lets you take advantage of the factory that you've already built. And so you get some compounding effects over time. And this is how you maintain the venture scale path after that first critical $1 to $10 million in 24 months. So if you're going to go down the venture capital path, it's important to understand that this is kind of the narrative that they're looking for. They want you to be able to hit venture scale in a capital efficient way. If you're not raising money, you still want to grow in a capital efficient way. At least that's my perspective on it. And so you need to understand, what does product market fit look like, and be able to reverse engineer. But if you are going to raise money, it always starts with this narrative. Find something that works, do it more often, then keep finding more things that work, right? Seed investors want to understand what that's going to look like in the future. Series A investors want to see proof. They want to see that your factory is actually working and at least one ICP, plus probably your second and third one are starting to ramp itself up. And Series B, C, D, the rest of the alphabet ranges, they just want you to see you scaling the things that already work. And they want to see that you're actually just repeating this process in your expansion, because eventually you're going to hit the top of that S curve and your growth is going to start to slow down. And you're going to need to find your second, third, and fourth acts if you're going to get to $100 million. Usually you'd probably need at least one second one, sometimes a third one. And those S curves have to start kicking up at scale when your first one starts to slow down. Otherwise, you're going to start falling off the venture scale curve. So remember, you can't hit a target you cannot see, and you cannot see a target that you do not have, right? So find something that works, do it more often, then keep finding more things that work. If you can define works, that gives you a roadmap. If you know that what that roadmap looks like, you'll know when you're ready to scale and you'll be able to manage your runway accordingly. So it's not based on time anymore. It's based on very clear milestones that are easy to measure, 1, 3, and 10. And with and this will give you a clear definition of product market fit that will focus your team in every single meeting. That's my last slide. We got 10 minutes left for questions. Feel free to connect on LinkedIn. You can just scan that QR code. It'll connect to me on LinkedIn. Happy to chat. If you want help with any of this stuff, just reach out to me. I'm happy to chat about helping you. I post a lot about raising capital, this concept of venture milestones, and product market fit.